Our session, Deal Flow in 2026, Market, Off-Market, and Other Factors, is now beginning in the session room.
Good morning and welcome to our panel discussion. I'm Ari Adlerstein, co-founder of T7 Capital, and it's a pleasure to be moderating today's conversation. For those of you who don't know T7, we are a boutique senior housing and healthcare advisory firm specializing in capital markets, equity, and investment sales. I co-founded the platform with Josh Simpson in 2025 alongside several of our colleagues in the audience today. I imagine many of you are wondering how we managed to pull together a panel that includes the CIO of one of the most active REITs in the country, a partner at one of the most active mezz lenders in the country, the CIO of one of the largest privately held senior housing and skilled nursing owners in the country, and the chief lending officer, by the way, congratulations, at one of the most active bridge to HUD lenders in the country. Here's my secret. I told each panelist there was a deal hiding somewhere in this room. If any of you can help me really look good to these guys, I would really appreciate it. Kidding aside, I was thinking back to the last time I moderated a panel at eCap. It was only 2 years ago, but so much has changed. The world feels very different today. My team hasn't tried to back out agency expenses from a P&L in at least a year. And while labor challenges persist, and they have not disappeared, they are no longer dominating every conversation. Instead, as I'm sure all of you know, every conversation seems to be the same, which I suppose means things have returned to normal, which is, where are the deals? Deals, deals, deals. So with that, let's talk about deal flow in 2026, on market, off market, and everything in between. But first, let's start with some quick introductions. James, I'll turn it over to you, and then we'll jump into the questions.
James Collister, I'm the Chief Investment Officer at CareTrust REIT. I've been at CareTrust officially for about 5 years, and like Ari said, we're a publicly traded REIT with investments in seniors housing, skilled nursing, and UK care homes.
My name is Jonathan Slusher, partner at Northland Group. I run the healthcare business. We're an investor in a couple different platforms. We're an owner of skilled nursing assets, actually with CareSpring. John Mueller is here. And we have 2 debt funds where we deploy mezz and portfolio transactions in coordination with banks. Plus, we're heavily involved with a couple owner-operators and helping them manage their balance sheet, raise capital, et cetera.
Ben Scheib, with Chief Investment Officer for Cascade Capital Group. We are a skilled nursing private company. We have, through our operating company, Legacy Healthcare, we have 100 skilled nursing facilities, and we're a large operator in Illinois, Iowa, and South Dakota. And through the place I spend my time, Cascade Capital Group, we're an investor on the real estate side of the business in about 40 states and another 200-300 facilities around the country.
Ben lost his voice on purpose to sound a little sexier.
I don't smoke, so I have to talk, add that rasp.
Tim Eberhardt, Chief Lending Officer with Capital Funding Group. We are a healthcare finance company. We do everything from bridge loans to HUD to accounts receivable finance. We've been in the business for over 30 years, privately owned by a gentleman named Jack Dwyer. And again, we've been a mainstay in the industry and plan on continuing to be, and very much open for business with flexible capital to meet any financing needs that you can dream up within the context of a deal that makes sense. So.
All right, I'll pick on James first. As one of the few REITs active in both skilled nursing and senior housing, what are the key risk factors investors are evaluating each of those sectors?
Well, I think they're really different. I think in skilled nursing, you're primarily looking at triple net deals, and you're going to be looking for really great operators who you have a ton of confidence in, can take on the risk of a long-term lease, who want the upside, and who have the hunger really to go get it. And you're looking at the risks of nowadays, always going to be reimbursement risk, Medicaid rate risk. You're looking at labor is always going to be top of mind for skilled nursing operators. I think in seniors housing, investors, you're looking at it a little differently. Triple net deals, for a REIT, you're really underwriting them as a spread deal. What's the spread and the yield over our cost of capital? Seniors housing, you're looking at it more from an IRR perspective, especially with SHOP and RIDEA structures, and you're trying to find, the right managers who can meet your needs as a public company for reporting, but who can also drive the growth year over year, because you're going to have to show same-store sales in a way that triple net REITs just don't have to. So you're going to really have to show that year-over-year growth pattern. And as seniors housing gets more competitive, that becomes a harder thing to show as cap rates get compressed, and you have to find the right deals that are going to get you that year-over-year growth that can show a low double-digit IRR return to the investors.
Obviously, you're at a skilled nursing conference, so you like skilled nursing better, right?
We always love skilled nursing better, of course.
Just checking.
No, it's where our DNA is from. It's where we feel like is always going to be the foundational, rocket for CareTrust growth. Will always be skilled.
Cool. And by the way, fellow panelists, feel free to jump in with any thoughts. Ben, our panel is focused on deal flow in 2026. There's been a lot of discussion about the difficulty of finding quality deals in today's market. Do you think that perception is accurate? And if so, what do you see as the root causes?
Well, I had a feeling you might ask that. So I was chatting with a lot of people in this room over the last couple of days, and everyone shares that perception. Deals are hard to find. Quality deals, I don't know, where's the action? And I think we're all feeling that. On the other hand, everyone I spoke to just came out of 2025 with their best year ever. I mean, everybody, the lenders, top year, the brokers, us as a buyer. It was just 3 months ago that I realized and prep for this meeting that the four of us closed a very large deal, all of us together, I think that closed October 31st. We closed $500 million deal. So there certainly have been deals.
It's 500 in US dollars.
US dollars.
Yeah.
So it might be a little premature to say like deal flow is dead given the 2025 we just came out of. Bigger deals, if that's what we're focused on. If you're focused on one-offs, I think those are still there. If you're focused on bigger deals, those are chunky. And it's a little too soon to call it here in February that deal flow is down. So I'm not sure it's 100% true. But I think there probably is some truth for it, and there's logic. I mean, the obvious answers, well, one obvious answer is because all the good deals are in Morocco right now, so there's nothing left for any of us. The other good, and the other like good reason is that there's just much less distress out there. And you mentioned that labor concerns, while not gone, are certainly nowhere near their pre-COVID, panic levels. Reimbursement is up in most states. Have gone through either a rebasing or price adjustment or conversion to PDPM that was helpful or something that's helping the operators. And I think the wind's at our backs on occupancy. So you got much less distress. And when people say where are the good deals, I think they mean value add and turnarounds. And a lot of those just come ultimately from distress. And now even the moderately distressed sellers, they just have more options. Capital is flowing very freely around this room, and there's options for refi over sale. And if you are selling, you're probably trying to get a little higher price per bed. You're trying to ride the wave, which is meaning like, oh, now I got a tax problem, and so maybe I'd rather refi. So there is some of that. There probably is fewer deals, and I think that the one other factor I'll say is, I think it's probably hard to pin this down, but I think over the last couple of years, there has been this massive industry-wide effect of like some really major special situations that have started to feel like it's normal business, but maybe as we look at historically over the last 5-10 years, it's not. But over the last 10 years, we saw the unwind of hundreds of facilities from Genesis. Cascade took over several bankruptcies, the unwind of one particular REIT and their assets. The unwind of Sava Healthcare led to a dozen or more transactions. I can name a few other kind of very special situations, and each of those led to a dozen deals. Dozens of people participated in Ensign deals, Consulate deals, Sava deals, the various Midwest deals that we brought out through other bankruptcies. And when you add that to the normal kind of mom and pop seller transaction flow, it makes the deal flow feel very large. I don't know if we're going to see some of those special situations that came out of the pre-PDPM conversion distress, and then the COVID distress. And some of those took a couple of years to filter out. You know, the people wound up in trouble, and then, you know, a large HUD transaction wound up back in the lender's hands, and it took a year or two before it finally made its way after COVID out. Those situations are not, that pipeline might have dried up for at least some time. The ProMedica transaction kept a lot of people very busy. I don't know how many total tenants there were in that deal. So there was a lot of very big transactions that were supplementing the normal deal flow. And I think that that's going to be gone for a while, just because I don't think we're going to see the level of massive unwind and distress that we saw over the last 10 years since Cascade came around.
Anyone else? I'll dumb it down.
Also, James gets all the deal flow directly anyways.
Exactly.
I mean, have you seen this moneymaker, guys?
I think, I mean, Ben's always going to be the most eloquent, but I think that to dumb it down for some of you, the way that I would put it is, I've been doing this for 15 years, and when I first started, there was a lot of institutional capital in our space that has to recycle through money pretty quickly. And over the last 15 years, I think that skilled nursing has been inundated with a lot of family offices that are flush with cash. And those family offices like to use this guy and others that will take your deals to HUD and just hold. And they're not sellers. You know, we want to hold it for our kids, our grandkids, and the next generations. And so I think there's only 15,000 nursing homes in the country, and a lot of our friends and family have recycled through a lot of those deals, and there just isn't a ton of like the low-hanging fruit. Not to say there isn't any, there is, but there just isn't a ton. That's my dumbed-down version. Ben is always more eloquent. Slush. By the way, I call him Slush. I have his permission to call him Slush. His real name is Jonathan Slusher, but it's much more fun. So Slush, do you think there's been a shift in the deal flow between marketed SNF deals versus off-market SNF deals that you're seeing? And if so, any thoughts on why?
So to separate seniors and skilled quickly, so we invest in about 400 buildings, 27 states across everything we do. We're probably 90% skilled, so we don't see a lot of seniors housing. I think if you look at seniors housing, deals are generally widely marketed. Most are large brokerage shops are showing packages, lots of REITs, private equity, family office, go down the list, are looking at those transactions. Skilled nursing has always been a bit of a balance of off and on, and that it's a pretty tight network of people acting within the market. So Ari and Josh, very busy, see everything. James, Care Trust, other REITs, also very active in the space. The past 10 years, we've seen kind of smaller transactions, then getting to portfolio transactions, the amount of merging of businesses, of individual facilities into enterprises, of a lot of the portfolios today, the expertise of M&A in this space has really modernized and has really grown up from when I first started financing this space about 10, 15 years ago. And what we're seeing now is when there's a seller, and your ideal seller is a founding family that's selling in a good state, has nice buildings. It's a legacy asset, so they're happy to sell and they like bringing in new talent. The real opportunity comes when an existing owner-operator is within that market, has a building nearby, starts to build clinical relationships, marketing relationships, knows the same hospitals, is involved in this similar state lobbying efforts, they're side by side, they're planting the seed very early. So that's what drives a lot of the very good transaction activity in skilled nursing. And technically that's off market, but then it ends up coming on market because Ari and Josh and others that are active in the space get involved. But the group of lenders, bank, mezz, the REITs, LP equity providers, it's a small world. So we all kind of end up seeing everything together. And each kind of stage we're in is really a cycle of where on the capital structure. The REITs have a really low cost of capital. They've been busy the past several years. Care Trust has grown meaningfully. And now there's direct conversations we'll have with an owner-operator. Sometimes there's no need to go out to market. It's really just making sure you're identifying the right capital source and then bringing them into your transactions. And it's because the space has matured. The owner-operator has the full team, the expertise, where they know what the market looks like. You don't necessarily need to go on market. Things can really be done off market, really more of a hybrid. So to just kind of add to your question, You know, there's a lot of transactions that have happened the past 10 years, as I mentioned. The families are still sellers. It's just, if they weren't a seller the past 3 years, now they're feeling much better. The buildings are busy. They're staffed well. Rates have now made sense where they can actually have a real Medicaid population. The buildings are profitable. But I'd also argue to them, it's probably the best time to also be a seller because the capital markets are about as liquid as they've ever been. Bank spreads will continue to tighten into the mid to low twos. The REITs are active. HUD's active. HUD had a banner year. It'll continue. And if you're a seller of a legacy asset, perfect market to trade in. Your execution risk is mitigated and you'll transact well. So hopefully they all see that and we do see the portfolio transactions, but it takes more time. It takes the teams that have planted the seed 2 years ago that are going to be front in line for that family that's going to turn into a seller.
I'm certainly biased, but the hardest part of my job when we have a quiet, quote unquote, quiet deal, because we don't really do the auction process, is trying to keep it at a synagogue, right? Like that's really the hardest part of the deal. And like we'll go to like one of our clients and say, promise me up and down, this is only going to you, this is super, super quiet. And then like the next morning I have 3 LOIs, it's wild. And so like even the off market, to your point, like even the off market process sometimes feels like it's on market, but that's just the incestuous nature of our industry, I think, and you know,
I think
the good and the bad.
I think also a lot of being off market is really just the seller wanting to feel like word's not going to get to their buildings, but there's still a marketing process that's just the broker is playing off the 2 or 3 most likely buyers against each other. There's very few deals that are like straight to one buyer. We see those, but an off-market deal is usually just a market a little bit more quietly.
Yeah.
And there's no point in blasting a package to 50 people if you know who your 3 or 4 likely bidders are.
I think that's true for larger deals where like there's typically going to be quote unquote the A buyer for that deal. I think it's less effective for the onesies and twosies where the Cascades of the world are not necessarily jumping up and down and saying, hey, I'm all over this. Really want this. Not to say you don't want the onesies. Ben wants the onesies. It's a shameless plug. So, okay, Tim, it seems like there's no shortage of capital for top-tier sponsors right now. Aside from financials and net worth, what really makes a borrower stand out and motivates lenders to be more aggressive on pricing and on leverage?
Sure. Well, I think the thing that when you talk about deal flow differentiates my business from James and Ben is that we're seeing flow because we benefit from recaps and refis and cash outs and HUD and so while there may not be as much M&A activity, we're certainly seeing a lot of opportunities. And to your point, there's definitely an influx of capital that's returned to the market. Top tier sponsors are getting very good looks from banks, and banks that were on the sidelines for many years are now, to Jonathan's point, pricing deals in the 200s.
175.
175. And that's a space that we can compete in also. We have a bank, we also have a FinCo arm of our company, and so we're happy to kind of look at both. I think where sponsors tend to differentiate themselves for us is, first of all, we are very busy and we look at a lot of opportunities, and so if we respond with a term sheet and it hits the bid, great, let's go. If it doesn't hit the bid, just come back, tell me what you want, and we'll give you a quick that works, that doesn't work, but let's not spend weeks sort of over negotiating a term sheet because that takes away from my team's time, it takes away from your time, and I think the sponsors that we enjoy working with the most are the ones that ultimately appreciate the relationship, know that we can deliver the transaction, and there's a little bit of trust factor there that we're going to figure it out in the 60 days between signing the term sheet and closing the deal. And then the other biggest thing that's a differentiator is in particular for repeat borrowers is just kind of past performance during your legacy assets. And I'm not talking about financial performance or did you get to HUD on the timeline that you're talking about, but communication is probably number one. timely financial reporting. If there's an issue, be upfront about it. It just makes my job so much easier when I go and pitch your deal to loan committee if it's a sponsor that they trust. And like I said, we've been in this business 30 years. We know that SNF can be a roller coaster, and patience is one of the things we pride ourselves on, but it's hard to have that when there's not that sort of two-way communication. So that's probably the biggest other thing, as well as just, if it's a deal that we did agree to and we agreed to kind of the terms of an exit or something like that, let's just adhere to that and move on to the next deal and not kind of keep renegotiating as we go. So.
I thought you were credit committee. This is confusing. You've been telling me the wrong thing all.
I have to have someone to blame when I have my opinions.
Do you find that borrowers are often renegotiating?
I think what you're saying is that lenders have to deal with retrades too. It's not only the sellers.
Yeah.
Yeah.
But sometimes that
We feel for you.
relationship helps
We
if
feel
there's
for
a
you.
pipeline of deals, and so like you have an exit fee if you don't go to HUD. Your whole platform is premised on your borrowers going to HUD, and sometimes things arise.
Sure. No, there's always situations where we're renegotiating or cutting deals, and it just has to make sense for both parties. I think the situations where it becomes tiring as a lender is when you just kind of constantly feel like you're being pushed down, and it just has to be a partnership that works for both parties.
Okay, James, what advice would you give a prospective new tenant when presenting themselves to a landlord for the first time? And on the flip side, what are some of the red flags that might cause you to focus on other opportunities instead? And please don't say the red flag is engaging T7. I know you were thinking it, but don't say it.
If they like lenders, we don't want to talk to them. No, it's a good question. I mean, I think with skilled nursing, I think we look for operators who are hungry and have a lot of energy to keep up with what is a constantly changing landscape. We want someone who has certainty and confidence in the model that they run. There's different models groups run for SNFs. We just want to see them having, certainty and confidence in the model that they run. We like to see track record, if they have it, of what they've done in other buildings similar to the ones that they're looking at. And understanding that, that they want to grow and they want a capital partner to grow with them. And we understand that eventually, if we pick the right operators, they're going to be of a size that they may not need our money anymore. And that's okay, but we want to find the right groups who are hungry and ready to grow. And I think, red flags are if they don't have their finger really on the pulse of their business, if they're too high, they don't really understand the nature of the business, or don't have the right, data of what's going on in their buildings to their fingertips, or if their culture isn't bad. I mean, you tour a skilled nursing facility of an operator, and, if people aren't happy, if there's no smiles, if hair isn't done well, if people are not happy, then that's an operator that maybe have some red flags. But honestly, in today's market too, I think that as a REIT, as a capital provider, that we've got a job to really sell ourselves to the operators as well, right? We've got to show them that maybe we're a little different, that maybe we aren't apathetic, indifferent institutional capital, right? That we can be sympathetic to operators, that we can understand their business hopefully pretty close as well as they do, and that can be a better long-term partner for them than maybe some others. And I think at CareTrust, that's a big part of what we work really hard to do. I mean, Dave's in the audience. He's a former nursing home administrator. We come from nursing home administrators in Ensign, and we try very hard to keep that DNA and try to sell ourselves to the operators as much as they sell themselves to us. They got a lot of choices, and we need to set ourselves apart as much as they do. And that's it. I've been great, guys.
Yeah. I think that was give James all your deals. That's what I heard.
Let me jump in. I'll just
Yeah.
add one or two things from the Cascade side, which is, there's some obvious things you can do, have track record and growth. But I think, I'm sure James is the same, is you need to look past that, because skilled nursing is getting easier in the one hand, because I feel like some of the macros are just much better for us now. But it's a hard business. And it used to be the number one thing is you need some guys with the energy to hustle and build the culture and be in the buildings, watch reimbursement. And I just don't know if just that bit is enough. I mean, the most successful operators are running really sophisticated strategies. They're doing high complex medical, and they're going, many operators are going substantially up. Reimbursement, and under PDPM, you have to really be on top of your game, and that takes technology and tools. People are using very sophisticated technology inside their buildings, everywhere from the back office to the rehab gym. And some of the great operators we talk to are doing really cool things on culture and management training programs and hospitality training programs. And it's not just as simple as being like, I'm gonna hustle. And so I think one thing you want to see out of an operator is someone who can hustle, because you can be way too sophisticated and bureaucratic for your own good, or you can be just too old-fashioned. And I think it's a hard road to follow and figure out who you're gonna trust to build a really quality company. Nobody needs a fly-by-night company with money. You need someone who's gonna make it, and that just, as home health and ALs come up, skilled nursing is getting to be a more and more sophisticated healthcare business.
And I think you want to look, can they scale, right? I mean, some operators are going to be done at 3 or 4 buildings because they have to be there all the time, and you want to look at a group, and that's fine for some operators. Like, that's great, but you want to know that. And can they scale, like Ben said? Do they have a sophistication level, and that they can really grow and scale what they have and keep the culture and keep the things they've worked so hard to get? Are they going to be able to do that at 10 and 15 and 20 buildings? Or are they a group where it's just going to be 3 or 4 and trying to figure that out going in?
I.e., the translation is it's not worth the brain damage to do one deal, a one-off deal for 2-3 deals, right? Like you want the relationship.
No, I don't think that's true. Sometimes the best operators, maybe they only want 2 or 3 or 4 buildings, and they can be really great operators in a small portfolio. And I think you want them too, right? But if you have a group who is that and brings you a 15-pack they want to do, that's a hard sell, right? Are they going to be able to stop, flipping burgers at the kitchen and when they have 20 buildings? Or are they going to want to be there all the time? So I think the small operators who want 3, 4, 5 buildings, whatever it is, they can be absolutely fantastic. But if they want to get bigger, do you have the confidence they can scale and they're the right group to do that? Or are you going to swamp them by...
They need to have the bench. They need to have a strong bench in order to do that.
Yeah, and vision, yeah.
Yeah, and just as you were talking, Ben, like you brought up technology. Like, are you using AI
It's all
bonus
anyone
question.
talks about.
Yeah.
And I'm not on the operations side of the business, but yes, it's becoming a real thing finally. On the you're seeing really good tools for the admission scrubbing, really good tools for the reimbursement side, and I think you'll see it more and more. I'm not sure exactly how far we're up to on the back office side for AP and AR, but yeah, AI is a real factor already. Last year, this year for sure is when I think a lot of firms have it in place, and I think we're just seeing the beginning of it too. I think it's going to transform everything from obviously bedside documentation and vitals, all the patient care side to the back office is going through a significant change.
Slush, you're dabbling in AI too at Northwind, right?
Yeah.
Yeah.
So we've built out tools, and we receive 400 income statements a month across our portfolio, and we have myself and 5 guys in Cleveland. That's it. So we build out tools that scrub, template financials, push out KPIs, identify key issues to focus on, so then our time is spent talking at the assets, talking with regionals, to the point of identifying a good operator. We have a portfolio trip, at least to CareSpring. One of the biggest things that when we underwrote that management team was, obviously there's someone who's kind of leading the business, they're an owner, they're the face, but the team of people below them, those 3 or 4 people, if they all had personal balance sheets on their own, could they own and run this entire business? And if they can, that's a very good test of, all right, they have the right people following the business. And building that team is critical, because without that team, scaling is impossible and unhealthy. So that's our best test of when we look at operators, is not speaking to the principal, but going down and understanding if the team of people following them have that skill set that they used to have, and their leader is building them into what they are. And culture is super important, because that's the same way that a DON should be pushing a caretaker, right? So it matters all the way to the top.
All right, I'll pick on you, Tim. There have been a number of HUD changes recently. Can you give us an update on the state of the union at HUD? What's new?
There have been a lot of updates at HUD recently. I think that the most striking number is HUD did over $8 billion last year in firm commitment issuances for healthcare, which more than doubled the prior year and is by far the biggest year on record. So they're very much open for business, and we're thrilled to kind of be in that space and be working with them right now. Since Commissioner Cassidy took over back in April. There's, as part of the new administration, there's definitely been a noticeable shift in just trying to be more efficient and effective as far as processing transactions. I don't think that any of it is to the detriment of the credit of the portfolios. They're still sort of going through the same underwriting process, and the requirements haven't changed, but the focus on execution and kind of being more pro-business from the sense of, ultimately time can kill deals. We all know that, and so, if we have a transaction that we like, let's get it from start to finish and closed. The biggest example of that is the express lane that they committed for, call it down the middle of the fairway deals. Submit, skip the queue. If everything pencils out, you could have a firm commitment within a week to 2 weeks. We have several examples of that we've worked on over the last year, and that's
qualifies for that?
It depends on the differences between skilled nursing and assisted living, and I'll probably misspeak a little bit, but it's generally on the skilled side, 70% loan to value, 2 stars or higher, 2 times that service coverage ratio, and a couple other nuances as it relates to the credit of the deal. But call it, like I said, down the middle of
And
the
like
fairway
you need trailing 12, trailing 24, or doesn't matter?
trailing 12.
Trailing 12.
Yeah, which is consistent with the rest of the program. So there's not, like I said, it's not a deviation in the credit quality. I think it's more of a recognition of when we have deals that make sense for the borrower, make sense for HUD, are accretive to the insurance fund, and our assets that HUD should want in the portfolio. Let's get them committed and closed quickly. And that's kind of had a trickle-down effect across everything else that we're seeing. The queue dropped drastically in the first half of the year. It spiked back up a little bit during the government shutdown, but even that's coming down a little bit. I'd say that the biggest pain point at the moment is on the legal side between issuance of firm commitment and closing, really a byproduct of a lot of the DOGE staffing cuts and attorneys leaving OGC, and then similar, the shutdown kind of built up a queue. So there is a queue on the legal side right now. If you get a firm commitment, we're not talking 6 months, but that's probably the biggest pain point at the moment. There's a couple proposals in front of HUD from the lenders as to ways to make that more efficient, but regardless, we're seeing those numbers come down, and it's just a more efficient, effective approach.
Okay, thank you. So Slush, as you look at new credit today, what risk factors are you paying closer attention to than you were a few years ago? Are there any states or regulatory changes that are making you more cautious today?
So, the great big beautiful bill passed. Skilled nursing was identified as a critical environment. So no bed tax reduction, but now it's the next step. Every state still has to make sure they're carving out skilled nursing and specific line items, making sure that that extra bed tax a skilled bed is paying is actually showing up in the budget for reimbursement. That's state by state now, and it's starting. There's definitely a lot of owner-operators that are upscale that have gotten together that are making sure and targeting the right states to get ahead of that legislation. That's super important the next 5 years of the industry, is to make sure that legislatively we're connecting the dots to the bed tax adjustment at the state level. So I say that because when we go state by state, let's say we're in Virginia, North Carolina, Florida, Ohio, kind of pick your state, an owner-operator that's in that state, I'd say 5 years ago, we had a little less focus on, are they really paying attention legislatively? Yes, they might be part of the associations, but are they meeting with the lieutenant governor? Are they meeting with someone who's running for Senate? Are they explaining the nuances that ultimately is in the legislation? I had a breakfast this morning with someone, and we were speaking about in Ohio, there's certain medication given to dementia patients, where if it's given to them, it actually lowers your quality points in Ohio. But that medication is super important for that patient to arrive at the building, have comfort, give the family comfort. That makes no sense. If we're looking for positive patient outcome, you should also reimburse to pursue quality. And it's the inverse for certain things in Ohio. That only happens if operators speak up and go and tell the right people. Not everyone's going to go spend dollars and time and resources getting ahead of these types of changes, but just voicing very specific things can make a really meaningful impact state by state. Same things go on in North Carolina, where they're trying to make sure that skilled nursing is identified specifically as that care environment and have a separate budget line item. Also super important. So the federal government identified it as its own care setting. State by state needs to do it in scale. Extremely important for the next couple budget cycles. So a new owner operator, we're entering a state, we expect them to have that knowledge. We expect them to be allocating resources to it. Because yes, it helps their portfolio, but they should be pushing the state forward, pushing the industry forward, right? Skilled nursing is a public-private partnership. You have patients, you have the employees, you have federal and state reimbursement. Obviously, the most time is spent with the patients, but in order for the business to function long-term, the clinicians, all the way to the principals of a firm need to spend time and resource and allocate and make sure they're explaining legislatively what needs to occur so that what they're doing in the building is understood. And that makes sure there's no waste, which is good for budgetary for state and federal level. But it's a complicated environment, and most legislators really don't understand it that well. So the more we all get involved in kind of pushing those agendas, positively will impact the space. And we expect all of our owner-operators to be actively pushing. And that's one thing, to the point we didn't focus on before, it's now, because the industry is maturing, and firms are getting larger, and they're becoming enterprise, and that's just the focus they should be having.
Are there any states that are on the no-fly list for you?
Not really. Depends. I mean, we typically like CON or heavy restriction on new beds. You know, we're top down. We start with the company we're lending to, the culture they've built, and then let's go see what kind of states they're in. If their product fits with what the state reimbursement and census that will ultimately show up at the buildings, does it match or not? So we're pretty open. We said certain states we wouldn't go into. California is one, but we now have a portfolio in California. It's doing extremely well. There's been good progression in states that we didn't love before. Texas is much better now. You know, Ohio went from 200 a day to 330 a day full quality point the past 10 years. There's a lot of states that are doing much better than a while ago when we would have sure had a list of no-fly zone. It's kind of gone away.
Feels like Illinois and Massachusetts have been picked on for so many years.
Yep.
And
No, Illinois still no fly list. Stay out of
Still
Illinois.
no. Says the largest landlord in Illinois. So Illinois and Massachusetts, but and James or Tim, like, do you have any states that you wouldn't touch?
I mean, I would put Connecticut on the list of states that used to get picked on that now we're doing loans in. I think the biggest states that I wouldn't say are a no-fly list, but we just have you know, sort of our antenna up on, or where they were historically, you know, below industry average margins and received major rate increases over the last couple of years. And it's not a question of will that get pulled back, but over time do those margins just kind of tend to go back to where they were 5-10 years ago. Nothing on a no-fly list per se, but that's kind of the states that we're the most concerned about.
Same answer. We always thought we had a no-fly list, and it turns out we didn't. As you know, states change and new deals come, and you take a fresh look at it. We also like to focus on the CON states, or at least say we do. But to be honest, the barrier for new construction is so high that I don't know that a CON is like essential. I mean, unless someone's building a very high rehab facility, they're not competing for the long-term business. In a newly constructed bed, it's just not economical, so I don't think you have to worry about competition on the long-term care anyways. So even without like a CON, I think we're still going. One thing you worry about is you worry about going to someone else's hometown. You know, you're going out of your comfort zone. What are we gonna do? You know, buying a facility in New York City. There's very sophisticated operators and very well-capitalized operators in New York City. We might just be out of place in certain markets. But other than that, no, I think the right deal, the right fit, same business everywhere.
James, same answer?
Same answer. I think we're really agnostic. I mean, you think you probably focus more in some states on the operator solution that you have, and they get you comfortable, and maybe tweak your underwriting a little bit based on, you know, if it's a tougher state, maybe want a little more credit from the operator or a little more experience from that operator in that state. But no, we're pretty agnostic on
Why did you
on
say
states.
no to my deal this morning?
Because it came from you.
What
There's
state
no
was,
better-
what state was it, Ari?
I'm not at liberty to
Look,
say.
I love fiction. That's why I love T7's pro formas.
I deserve it. Matt, relax. Okay. On that note, we'll open up to the panel. Based on deals that T7 has recently shopped to lenders, it feels like there's a lot of liquidity in the market right now. And honestly, to me, it feels like this is like pre-COVID liquidity, where I like to say the hardest part of my job is we get 6 term sheets and we got to tell 5 of our friends no. Because truly, I think that, in order for us to do our job, we are very, very aware of the time that goes into our lender friends putting in the energy and effort to get through their credit committee and to get us a term sheet. And it's kind of crappy. Like, you just did all the work and, somebody else came in 15 basis points cheaper. It hasn't been a problem that we've really dealt with since pre-COVID. And, like during the COVID era, it was like, yay, we got a term sheet, let's go. I don't care that it's 500 over. Today it's like 275. Like, come on, guys, you couldn't get me 250. And like, that's the environment that I feel like we're in a little bit of today for at least quality sponsors. So what are you all doing to differentiate yourself? And by the way, it applies to you too, James. Like, there's a lot of liquidity in the market. So how is everybody, and with that, with the last 3 minutes that we have, I'll start with you, Tim. How are you differentiating yourself?
I think the biggest thing that we preach to our clients and potential clients is, yes, we're in a very good capital market environment right now, but this is a volatile industry. And so when you're making your decision about who you're going to go with as a lender, sometimes chasing the last basis point is not the most important decision. I would argue there's a lot of other factors that you should put ahead of that. While, again, pricing was good, not going to deny it, we did more skilled nursing lending in the post-pandemic or during the pandemic than many of our competitors, and a lot of banks just kind of disappeared from the market at that point in time. And so obviously if it's 100 basis points or something like that, look, you got to go with the term sheet that makes the most sense for you. But at the margin, I think you want to have the perspective of working with someone that this is their primary business. We've been doing this business for over 30 years, and we're pregnant, I guess, with skilled nursing and not going anywhere regardless of what sort of the cycle brings.
Well, the same question for me. We're obviously not putting out term sheets, so but I'll give advice to the lenders out there, which is, lenders, you very much want a relationship lender. We all talk about it, everyone wants it. And that means you might not be chasing the last basis point in every deal. But we also have to worry that, lenders are also reviewing every deal, as if it's like the first deal they've ever seen. Oh, you're gonna do this well, give us a couple weeks, maybe we like this one, maybe we don't, maybe these basis points, maybe the spread on this loan is gonna be bigger. If you want really a relationship, it has to be programmatic on the offer side also. You have to find a way to say yes to most deals so that we as borrowers don't have to feel like, well, we have to shop, because otherwise you might say no to this deal. So I think lenders, they have credit committees, and their credit committees, most of the originators don't have an easy credit committee behind them, and they have work to do to get past deals. But I think that as a company, most lenders, which CFG has done a fantastic job. This is, they're the inspiration for every lender out there being reliable, because we all want a partner you're going to get to the closing table with. Stuff happens in deals, performance dips, something changes, there's a timing delay. You need a relationship lender, but if you want to not be shopped for every last basis point, you also have to make it not a bid process for every deal, which means you have to be a yes sayer, or it's going to go that way.
So, we lead with advice. That was my banking roots. I started work at Key out of school. Key Bank is very much the banking mantra of lead with advice, generate fees, hopefully don't lend. But at Northwind, the idea is we get very integrated with the owner-operators that we capitalize. There's probably 10 that we have very large commitments to across their portfolios. And We like to help them think about the business, how to fully capitalize the business. And this environment, which is going to turn even more competitive than it is today, we have banks in the twos, the REITs have a good cost of capital, HUD's active, there's myself as Mez, plenty of others. It's a very robust liquid market. It's a good thing. Yes, it makes life tougher. You have to work harder to find transactions, but that's really where we just need to work hard and be more creative and identify opportunities. And James's capital will fit one deal, my Mez will fit another deal, CFG will exist in another deal. And we all kind of work together in a way. It's a kind of a very friendly capital market, I'd argue. And it's a good thing. So.
I would just say I despise all these people. We want all the deals. But no, we're a good, calm, committed transaction partner. We want to sleep at night like the operators. We'll trade some yield for coverage and want to be a great, flexible partner going forward.
Thank you, gentlemen. I think we're out of time. Thank you so much.